Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Oana.
Okay, we are going to talk about whether the housing market is actually in trouble. So this all stems from this tweet slash X post that was put out with a chart. Now, this I'll read. First, I'll read it. I don't know who this Bravo's research is, but I did read through the thread, and this is a crash bro. This is a person trying to get a bunch of views and interaction based on some doom porn. So here we go. Warning. Now remember, I just want you to think about the chart in your head and then paint what picture this says when you see the chart without any actual information, because it's going to bias you. Okay. Here we go. Warning. Housing defaults have skyrocketed. Housing defaults have skyrocketed. This is unlike anything we've seen in a decade. And then this chart. Now, what I want you guys to do, Juan and I are going to have a little conversation, is look at the chart. There are specifically three things in here in this chart that are highly misleading, that don't actually lend to what the thing is. And we have some more data. We have other good charts that we're going to talk about. Juana, how do defaults or foreclosures? Because let's talk about that first. What does default mean? Does that mean houses is being sold on the auction at the courthouse steps by the bank?
Well, kind of like the word implies, it's a fault. It's something that's negative that has happened, right?
Okay.
And in this case, a default is somebody simply missing a payment. That's a default.
So if I miss a payment, it gets reported, and this data is all tracked. It's tracked by the consumer CFPB.
Right.
Okay. It's so a default.
Right.
And then what happens, I forgot to mail in the check or whatever, and then you get current.
Right.
Okay, then it's not in default.
Correct. You bring it current, and now your account is in good standing, and life goes on.
What's the logic here? Is the logic here that there are just so many people that this skyrocketing number of defaults will all lead to a wave of foreclosures, and the wave of foreclosures will lead to a housing crash like we saw 15 plus years ago? Now it's been almost 20 years.
I mean, none of this makes any sense. So let's kind of back into this a little bit. We can assume, and I know assume is a bad word, but we can assume that people who have mortgages are reasonably fiscally responsible and that they would be less likely to be in default than maybe somebody who is not a homeowner, right? Maybe a tenant. So maybe we would see evictions start to skyrocket before we would see evictions of tenants start to skyrocket before we would see mortgages being in default.
Okay. All right. So here we go.
The premise of that is economic hardship across the board in the country.
Okay. So what we're going to do is we're going to dive in this chart. First thing, most obvious thing, this chart has nothing to do with houses. Single family homes. It says at the very top, this is the delinquency rate of multifamily. Juana, what's multifamily?
Well, that's commercial. That's not residential. So that's not what we're talking about. It's not housing. Housing refers to single family or townhouses or condos, that sort of thing, right? So this is single family. What this chart refers to is commercial loans. Think apartment buildings, right? Think 200-door apartment buildings. That's what this is talking about.
Okay. Also, that's the first thing. It's not single. It's not like your neighbors. Okay. This is the apartment complex down the road from you. The second thing is remember, these are just seriously delinquent. Okay. 0.4%. Juana, 0.4% means 1 in 250.
Mm-hmm.
1 in 2. So it means if where the town you live in has 32 apartment complexes, chances are none of them are in default. Everything's happy. We're talking 1 in 250 of these. Also, remember, we just exited the biggest boom ever of multifamily building. Remember, a lot of these are units that they've built them, but they haven't filled them up with tenants. So they maybe aren't paying their bank that they borrowed the money against, right?
Right. So you're dealing with a couple different things. First of all, like you said, these are apartments. We don't know where they are in the process of getting them initially filled. The other thing that we're dealing with is We did have some pretty bad hurricane season in the South this year.
Mm-hmm.
There are a lot of apartments there because they've had a lot of growth, right? So when you have a lot of growth, you have a lot of apartments. As a matter of fact, the South experienced more apartment building over the last couple of years than the rest of the country. So because they
Combined,
had
58%.
right. So because of that, so now you're dealing with a lot more units in an area that experienced weather challenges and destruction and that sort of thing. So that's part of what this is about. So it's not just distress because of normal economic things. It's also distress because of these hurricanes. So it's a combination of things. And like I said, the South did have more apartments being built, so they were outside. So apartments were outsized, influenced by what happened with the hurricanes.
Okay. The other thing on this chart was, look at the previous peak was 2011 and 12. The residential housing crash had happened, and home prices were already starting to go back up.
Right.
So they're trying to make you believe that like that was the housing crash and this is the second one coming, because it's clear on this chart. And remember, when was the apartment multifamily housing crash? When did that happen? You guys don't remember that because there wasn't one. Not when 0.4%. This is ridiculous. This whole tweet, this whole thing.
So to me, the biggest deceit in this is labeling it as housing. It is not housing. These are commercial buildings. So I think that needs to be emphasized. This is not housing. This is commercial building. So those of you who live in a townhouse, in a single family home, in a condo, this has nothing to do with you. Those of you who live in apartments, this still has nothing to do with you because you are tenants in these apartments, okay? So you're making your rent payment, that's all hunky-dory. Even if an apartment complex, let's say, was to be foreclosed on, which is actually pretty rare, even if it was to be foreclosed on, you would not be impacted. You would still have to continue making your rent. There would simply be a different receiver on the other end of your rent. Maybe even the management company wouldn't change. Why would the bank want to change the management company? They wouldn't even do that. It's in their best interest to maintain the management company, maintain everything, keep everything going while they find a new buyer for the apartment complex.
If an apartment complex that's adjacent to a big residential area, if they went in default and the bank took back the apartment complex, would that crash the housing market? Like, would it spread somehow into the other residential neighborhood?
Okay, so it's like saying that if a car dealership goes out of business, somehow that has anything to do with the houses around it? Has nothing to do with it.
Here's the actual chart. This is mortgages. This is actual people's mortgages on homes that are 90 or more days delinquent. It's the national average. It goes back 2008. You can see at one point it was 5%. Of course, that was all alleviated. Some was through foreclosure. A lot of it was just through people got current or they got loan mods or something like that. Okay, you go all the way to the right. Does this chart look substantially different than the previous chart? Yes. And this is actual housing. As a matter of fact, this is another interesting thing, Oana. 42% of all homes are owned free and clear, right? So this is only people with mortgages. So we're only talking about 58% of the whole housing market that have loans. And of that 58%, call it 60%, you have 0.6%. So that's 0.36%. That's like 1 in 300 houses are actually, they're only delinquent. They're not even being foreclosed. That's like literally zero.
Right.
It's zero. And that doesn't mean that they're going to get foreclosed. Here's the other thing too. If you go back to even 2008, 9, 10, only 20 to 23% of all homes were owned free and clear back then, about half. So you had more people have mortgages. What's interesting is, I'll give you an extreme example to sort of prove the point. Let's say that every home in the US was free and clear. Nobody had a mortgage. There's really no risk of foreclosure, like not from your mortgage. But one guy had a mortgage, one person, and he went 90 days delinquent. The Crash Bros would show a chart. 100% of all mortgages in the US are delinquent. And this will cause this one will cause the housing market, because when he has to drop his price to sell, it'll force everyone else to drop their price and the whole thing will collapse because it's all made up. Pretty ridiculous, right?
Pretty silly. Look, we have a lot of things going on, right? First of all, people have jobs. So if you look at the unemployment rate, it's pretty low. Number two, we have a pretty decent economy. And I realize that not everyone's benefiting from it, but we do have a pretty decent economy. So low unemployment, decent economy, inflation's coming under control. That's a good thing. Lots of people have equity in their homes. There are not a lot of homes on the market, so somebody who needs to sell their home does not have a difficult time selling their home because there's not sufficient inventory for the demand. So we're in a good place. On top of that, we have people that have a ton of equity. To Todd's point, back in the day, about 20+% of people had homes that were free and clear. Today, we're talking over 40% have homes that are free and clear. So twice as many people have homes that are free and clear. The mortgages that we have today, most people have somewhere around 3% or lower mortgages, right? So again, that makes homes affordable. We have people with lots of equity because, of course, we've all experienced, for the most part, a rise in equity throughout most of the country. Most of the country has benefited from that. I realize not everywhere, but most of the country has benefited from a lot of appreciation. So now people have equity. What happens when you have equity? Well, when you have equity, you have the luxury of being able to sell a home when you're ready and put money in your pocket. So that means that someone who's behind on their mortgage has the opportunity to either get current, work something out with the bank, or sell the home and put some money in their pocket.
Okay, you guys have been looking at while I was talking, I put this chart up. This is the loan to value ratio for only homes that have mortgages. This is, okay, so 42% of people have zero debt if they own 100% of the house. The other 58% own over half because the mortgage debt, the loan remaining on average is about 46, 48%.
So I like easy math. So imagine you have $1 million home. And you only owe, let's say, $450,000 on your $1 million home. You're going to let that get foreclosed? Probably not. Yeah. I don't think so. So, you have lots of choices because you have lots of equity. That's easy math. So for me to illustrate to you why these people are not going to get foreclosed. They will find a way to manage, whether they bring the loan current, they work something out with the bank, or they sell the property.
Okay. The last chart. This is every country in the world, the developed countries that have a mortgage program where you can get a house with a mortgage. And it shows the most vulnerable countries, meaning vulnerable to rising interest rates that have variable loans. And that is all the way on if you're on the right, you have variable loans. If you're on the left, you have less variable, more fixed loans. If you're at the
red, you've got variable rate loan. Not red, you don't have variable rate loan.
Something like that. It's left and right. Then top and bottom the top is the amount of percentage of income as a nation it would take to pay off all the mortgage debt in 1 year. And then the bottom, so where you want to be on this chart
you want to be in the bottom left-hand corner.
Bottom left corner. That would be the safest, most stable, least risky housing market on the planet. And if you're on the right-hand side up in the corner, that would be very bad. Norway, Australia. Guys, can you see where the U.S. is on here? If you can't see it or you're just listening, I will tell you. It is it is the lowest left thing. It's the closest thing to that. We call it the XY axis, 0, where it's the closest one. The next one is basically like Germany, maybe France, and Belgium. They're pretty safe. Ireland, Spain, Italy. Okay. The housing market, despite what the crash bros tell you, is not at risk of collapsing. It's been affected by rising costs because of building costs. What else, Juana? What else has caused home prices to rise?
Well, so supply and demand, right? I mean, we have more demand than we have supply, so that will cause home prices to rise. Inflation, that thief that steals from all of us, that has caused home prices to rise. The thing that we have going for us is that very few mortgages in the U.S. have a variable rate mortgage. Now, the reason for that is, number one, they haven't been popular for about 20 years. Number two, we had, of course, those fabulous interest rates for a couple years that were in the 3% give or take range. So lots of people that maybe did have a variable rate mortgage chose to lock in a great rate. So that's another reason why we're in that situation. So not only that, but we also have lots of programs that enable home ownership, that encourage home ownership in the U.S. Between the tax code and the way we can borrow money and all these sorts of things. Those enable us to be homeowners and to be in that bottom left-hand corner.
The chances that when somebody says, oh, but look, it's, home prices are up 40% in the last 5 years. Well, so are wages. Like, I would say there's a greater risk that your employers would come to you all as a group and say, hey, I know that we gave you used to make 45,000, but now you make 65,000, but we're going to wind that back because, it's wage inflation. It's a bubble. It's a wage bubble. And we're going to crash the wage market by reducing your pay. And I think we all know that's not going to happen. But because you're making more money, you can afford more house. And it's not, despite what Crash Bros have told you, yes, it is more unaffordable today to buy a house than it was 3, 4, 5 years ago because home prices are up and interest rates are up. But there's almost no risk. The current people who currently own houses either own them free and clear, they have an extremely low interest rate, or they have so much money into the house. Then you have a small sliver of people who maybe have super high, 6, 7%. Oh my God, that's so crazy. I can't imagine that. 6 or 7%. First house I bought was, I think it was 10 or 11% interest rate. And maybe they don't have a ton of equity, but they don't want their credit trashed by getting missing payments and getting foreclosed. So I don't believe there's a housing crash coming. I don't believe there's any great reset. Crash Bros, this is 5 years in a row now. Started in 2019, housing crash.
So kind of recapping that particular, the tweet we started with,
yes,
or the X post that we started with, that was really deceptive and it was dishonest. So that doesn't apply. That has nothing to do with housing. It has everything to do with commercial loans, and that because that's what apartment buildings have, are commercial loans. And even at that, we discussed that that has to do with the number of apartment complexes that were built, and that this was particularly influenced by what's happened in the South with the hurricanes, because apartment buildings were built more there than anywhere else in the nation, and that's part of the reason why that looks that way. But that has no impact on you who have a home. So ignore that person, or at least don't contribute to their likes and tweets and follow them, because they're not somebody that is going to give you honest information. They're just somebody who is looking to benefit themselves.
I'm going to put this chart up again really quick. It's set, when I took a screenshot of this, 620,000 views, 620,000 people. This is what they did. They went, warning, housing defaults have skyrocketed. They looked at the chart and saw the red lines and went, oh, wow, this is just like the bubble. It must be the bubble's going to burst again. I'm not buying a house. I'm out of here. I'm done. I'm going to wait 5 years if prices don't drop 40, 50%, I'm not going to buy a house. Well, they literally, I bet I read through the comments, almost nobody said, hey, dude, your chart is multifamily homes. This is not single families. I was the only one. I just put this is not the housing market, this is apartment buildings.
Right. So hopefully you found this interesting. This means that when you're checking out posts, look at them a little more carefully before you draw a conclusion and think that the sky is falling, because it may not be falling. It may just be somebody trying to get you to follow them or get something out of you. So just kind of keep that in mind. Hope you enjoyed the video. If you missed us, well, you know what? We've missed you too. Happy Thanksgiving. Hope you're enjoying Thanksgiving with your family, friends, and loved ones. Remember to like the video, subscribe, hit the notification bell, share the video, and we'll see you on the next video. Bye.
Bye.